Namaste to all. I welcome you all on this very important virtual outreach hosted by the Accounting Standard Board of ICI. And we thank the IASB for joining this outreach program to have a discussion on the exposure draft related to our IFRS 3, read with the IAS 36, of course. And for this, we have got our members from IASB, Mr. Zachary Gast, who is the member of IASB, next Akshay, who is the technical staff member of IASB, Mr. Vikas Kalidas, also another technical staff from IASB, and of course, Ms. Mesler from again, the assistant technical staff of the IASB. We welcome all the four team members from the IASB, and thank you for joining to share your views and on this very, very important exposure draft. And thereafter, of course, we have our own team from India, I would say, starting with, of course, we have our own past Central Council members, Sanjay Vasudevaji, Dr. Avinash Chandraji, C.S. Smriti, and of course, the moderating them, another of our stalwart, Sumit Sethi. We will be talking about that because they would be taking the session after the initial discussion. Friends, when the IASB issued IFRS 3, thereafter they went for the PIR, and thereafter there were various concerns or issues raised by various member countries. Various stakeholders they raised, importantly, they talked about that the investors were not having sufficient information about the performance of the acquisitions in doing this business combinations, post-business combinations, I would say. The impairment testing, if we talk about, they were being costly and complex, and even on Goodwill, sometimes they were recognized the impairment losses very late, and how to amortize the Goodwill. So, keeping all those concerns in mind, the team of IASB explored to address this concern on the project titled as the Business Combinations, Disclosures, Goodwill and Impairment, which has resulted into this development of the exposure draft. The exposure drafts were set out, actually, the package of proposals that in the IASB's view would be resulting in companies providing better information at a reasonable cost about the acquisitions, thereby responding to stakeholder concerns. Also, it is a proposal to add various disclosures in requirement of IFRS 3 and the amendments relating to impairment of the CGUs, the cash generating units, containing the goodwill in IAS 36. The proposed disclosures requirement in IFRS 3 would require actually an entity to disclose the information to allow the users to make a better assessment of the success of a business combination. And of course, the target amendments to IAS 36 would be relating to the calculation of the value in use, the allocation of goodwill to the CGUs, and the disclosure requirements. And of course, to gather that feedback on these proposals from the Indian perspective, we are having this outreach. Let me just have a small introduction of our speakers from the IASB, the International Accounting Standard Board. Mr. Zachary Gast, who is a member of IASB. Of course, prior to joining the IASB in 2020, he has worked in the Center for the Financial Research and Analysis, that is the CFRA, which is a provider of independent investment research, where he served as a president directing the organization's forensic accounting and equity research strategy. Welcome, Mr. Zach, to share your views on this outreach program for the amendment to the IFRS 3. Also accompanying him is the technical staff from IASB, Ms. Akshay Megarik, of course. From the name, we feel that you are from the Indian subcontinent, the background thereof. So I say PIU. So she is an IASB technical staff. member and is part of this project, the Business Combinations, Disclosures, Goodwill and Impairment project team. Before joining the IASB technical staff, she worked in an accounting firm and as a technical accounting specialist and has several years of experience in the financial reporting and evaluation. Joining her is also another, I would say, our person from the Indian origin, Mr. Vikas Kalidas. He's also IASB technical staff member and is part of this project team. Before joining IASB technical staff, he worked as an accounting firm in a technical accounting specialist for several years. And of course, they are assisted by their assistant technical staff, Mr. Mislam, who is this part of this project. And before joining this IASB technical staff, he worked at the bank as an analyst. So before we go further, of course, I'm joined by my vice chair. So before I hand over for the initial discussions to Mr. Zach, I'll request our vice chairman, C. Abhay Chajji, to share and welcome everyone into this initial views.
Thank you very much, CA Pramod Jainji, the chairman of the Accounting Standard Board India. So truly an honor and privilege to have experts from international accounting standard boards and the technical staff, and of course the experts from India, the special invitee, of course, Dr. Avinash Chandar and Smriti and Sanjay Vasudeva, the past Central Council member from India, and Sumit, of course, being, always there in group discussions whenever we get an opportunity. So thank you so much for joining. And thank you, Zach, Gast, Vikas, Miss Love, Akshaya. So truly an honor. We have, I think, excellent initiative, I would say, an initiative, of course, from the ASB and the staff, joined by Parminder. She's also there. And so I'm sure we'll have an excellent discussion. Very important, the exposure draft, which has been there now. It's to be responded, I believe. I think maybe we'll have some more discussions, concluding remarks. We'll have some question answers to the moderators. So we'll have more time to discuss going forward. So I hand it over back to the chairman, Pramodji, for further proceedings. Thank you very much.
Thank you. Thank you, Abhay. Friends, this outreach program on this exposure draft is important because ISB is seeking the comments throughout the world, and India, of course, would be submitting their comments. We are expecting to submit our comments by 15th of this month. And prior to that, also, we are having our board meeting. So today's outreach meeting would also help us in crystallizing our comments, which we have to send. Of course, we'll be finalizing in our board also. So hoping for a good learning and good discussion out there. So handing over now here and requesting Mr. Zach, who's the member of IASB, to take it forward from here.
Thank you. We definitely appreciate the welcome introduction. And on behalf of the IASB and the technical staff, we genuinely appreciate the opportunity to come here and speak to you today, answer any questions you have about the exposure draft, and then hopefully get into some discussion about what your preliminary thoughts are and feed into the comment letter. So with that introduction, why don't I give just a very brief history of this project? I'll try and keep it to a couple minutes, and then we can dive into the details, which the team will go through on the specific proposals. So as you mentioned, the PIR process started 11 years ago, 2013, on IFRS 3. And we've worked through first a discussion paper, which came out in 2020 and went over a few more aspects of the project than we've narrowed it down to today. But about 4 months ago, we put out an exposure draft, which narrowed down the topics we're focused on and got to some specific recommendations on those. And the recommendations come in two specific areas for standard setting. One was responding to this long-seen user need of providing more information on business combinations and hopefully better information. In the discussion paper, we heard some concerns that we were going to get into disclosure overload for companies that did lots of acquisitions, and there might be commercially sensitive information. So we've added a couple things to deal with that issue. One is a threshold for increased information, what we call strategic acquisitions. We've heard we may not have picked the name very well already in feedback, but that's what we've chosen to call them and to focus on for most of the increased disclosures. The second thing was we added an exemption for disclosures where when a piece of information could seriously prejudice the achievement of a company's acquisition goals, they would be exempt from releasing a piece of information. So with those two things, we built an increased set of disclosures around all business combinations, but particularly those that are strategic for the company. The second piece of the proposals that we're going to go over today are making some changes to the impairment test. These are all things that came through in the PIR and then through the discussion paper. There were additional changes we considered and ultimately decided not to proceed with because of perceived difficulty or that they wouldn't actually cause a great deal of benefits, but might create additional costs. And ultimately, what we think we've arrived at is a package of proposals that really seeks to balance some of the user needs that we heard very early on with some of the preparer concerns around how the information could be prepared and what the cost of that would be, both in terms of financial costs and proprietary costs. So with that, why don't I turn it over to Vikash and have him walk through some of the specific proposals, and then we can get into a discussion of those.
Can you see my slides? Yes. Thanks, Zach, and thanks for the introduction. And I just echo the thanks for the opportunity as well to speak to you today, and hopefully we can provide you with some insights into how the exposure draft was developed and some of the feedback we're hearing so far, and get some of your comments and feedbacks as we progress towards the comment letter deadline and beyond. What I'll be doing shortly is just taking you through the background of the project. I think Zach and Pramod have already given a reasonable amount of background, but I'll just try and highlight some additional elements of the background to the project. I'll then be passing to Mislav, who will talk us through the improvements to disclosures about business combinations. He'll talk about 4 different sort of parts of that, being the disclosures themselves, information about expected synergies, and then the 2 critical changes since the discussion paper phase around the subset of business combinations being strategic business combinations and exemption. We'll then pass to Akshaya, who will talk about the proposed changes to the impairment test, and they will cover both the changes to improve the effectiveness of the test and changes to reduce the cost and complexity of the test. There's also a little bit of content around why the ISB did not reintroduce amortization and how that decision was made. And then, of course, there are some examples in the appendix to the slide deck. We may not necessarily discuss them in detail today. However, if it's helpful to answer some of the questions we might get, we might just refer to them during the presentation or during the question and answer stage of the presentation. If I move on to the background, so I think this has been highlighted quite well. I think the key thing I just wanted to remind everyone of here is the objective. So the objective is to improve information that entities provide about their business combinations at a reasonable cost. And then, like Zach said, we've got the package of proposals. It's proposing amendments both to IFRS 3 and IFRS 6. Comment period is due shortly, so next week, Monday. In terms of the history, I think, again, Zach covered this quite nicely. This just puts it sort of on a timeline scale for you. A lot of work was done since the publication of the discussion paper. The ISB heard a lot of feedback. We'll be giving you some of the highlights of that feedback as we go through the presentation. And yeah, so there was a lot of work done since March 2020 to get to the phase we're in now. And yeah, it really all stems from that post-implementation review of IFRS 3. Something maybe that I can add in terms of background that we haven't really touched on much so far is around why this exposure draft is being published and why investors are interested in this information. So what the ISB heard is that investors care particularly about business combinations, and they want more information on business combinations because they view it as a particularly high risk form of capital allocation that management embarks on. And it's different to other capital expenditure that management might incur, for example, through growing its company or buying buying equipment or PPE in factories because of the value. So there's normally much higher value attached to these transactions, and there's some data that sort of backs that, which we've got on the slide there, around 3.2 trillion of deals in 2023 alone globally. So it really forms a central part of how the economy works globally. In terms of the concerns and how they fit into the proposals, so I think one key thing, and we will repeat this later on, explaining how it works exactly, but one key thing is that there was a lot of discussion in this project around the reintroduction of amortization and around changes to the impairment test. And one of the key things just to keep in mind around those concerns is that investors were using or are using the impairment test as a proxy to determine whether or not a business combination has been successful. So that's what we heard from investors, that they're looking at the impairment test, information related to the impairment test to try and confirm whether or not an acquisition was successful. And many of the comments that were raised around impairment losses being recognized too late sort of stem from that underlying reason. And what the ISB is trying to do is to address that concern more directly by providing information about the performance of an acquisition directly to investors, rather than them relying on the impairment test. And it got to this conclusion not very lightly. So there was a lot of consideration around IAS 36 and around reintroduction of amortization and whether that could provide useful information to investors. But really, the impairment test, as we'll discuss later, was not designed to demonstrate the success of an acquisition. It's really just there to assess the recoverable amount of assets on the balance sheet, including goodwill. And that's why providing this information to investors directly makes sense. There were also some other separate concerns that were raised on impairment tests around cost and complexity. And there are a couple of changes that are being proposed to impairment tests to try and reduce that cost and complexity. And we'll talk about those. And I think those so far, I mean, just to give you a bit of flavor in terms of feedback, those so far have been quite well received by our stakeholders in the meetings we've had. This slide is just a very high level summary of the proposals under each of the standards. I think one thing I'll just mention here, which we haven't really spoke about, and something to keep in mind as we go through the presentation, especially around the IFRS 3 proposals, is that it follows what we call a management approach. So it's information that management reviews that's required to be disclosed. And Mislav will talk about that in detail during this section. This slide just tries to demonstrate, again, the point I was trying to make previously, which is that some of these proposals address concerns, multiple concerns. So concerns about the impairment test are being addressed not only through changes to IAS 36, but also by providing these disclosures more directly. And that's why we are branding this and why we are talking about these proposals as a package of proposals. And that's why the ISB considered them together in developing this exposure draft. So everything works together to address the concerns. It's not that specific proposals and specific standards only address the concerns of that standard. They work together to address the concerns overall. In terms of what we've been doing since the publication of the exposure draft, so this just is a very high level summary of the types of questions we've been asking in the exposure draft around whether or not the proposals balance the benefits of requiring the disclosure and the costs incurred by companies, and then whether the proposals in I-36 do what their objective was, which is to improve the effectiveness of the test and reduce cost and complexity of the test. So that's a very high level background and introduction into what we'll be talking about in the next few minutes. I'll now pass to Mislav, and Mislav will talk about improving disclosures about business combinations.
Yes, thank you, Vikash. So yes, as you just said, we'll be looking at the ISB's proposals relating to disclosures about business combination in a bit more detail. So if we go to the next slide, you can see a very high level, basically a high level showing of our proposals, which is there are essentially three key elements in the ISB's proposals. First is about providing information about performance of business combination. Second is about disclosing quantitative information relating to expected synergies. And third is about exempting an entity from disclosing some information in specific circumstances. And we'll look at each of these three elements in a bit more detail in the following slides, actually. So yeah, if we move on to the next slide. So before getting into the specifics of the proposals, I just want to re-emphasize that these were intended as a package of proposals, and rather than isolated pieces of requirements. And this is to seek the appropriate balance between the benefits of disclosing this information with the costs of disclosing it. And so basically this slide highlights feedback that we received from investors and preparers. So on one hand, we have investors who say they need this information because it helps them assess whether a business combination is a success. So they need information about the performance of a business combination and expected synergies as well. And what we heard is this helps them assess management stewardship of entities' resources, and in particular in how good management are at capital allocation. And as I think Vikash and Zach both mentioned, what we heard is that impairment test hasn't been adequate in giving and showing them this, basically signaling this information about whether a business combination is a success. And so the ISB tries to provide this information more directly. And on the other hand, what preparers told us is that they have concerns about disclosing this information because it could be commercially sensitive or viewed as forward-looking, which could lead to some litigation risks in certain jurisdictions. And so to address these concerns, the ISB is providing an exemption, which we'll look into a bit more later on. So moving on to the next slide. So this is what I would consider the main proposed disclosure requirements for IFRS 3, which is information about the performance of a business. And so an entity would disclose in the year of acquisition key objectives and targets for a business combination. And then in subsequent years, the entity would disclose the actual performance against those key objectives and targets. And the ISB is proposing that entities should disclose information about the performance of what it calls strategic business combination, so a certain subset of business combinations. And this is to help to, as I said, to achieve the right balance between costs of disclosing it and benefits that it gives to users. And so the ISB would exempt an entity from disclosing some items of information if specific conditions are met. So if we move on to the next slide. Yeah, so this slide shows in a bit more detail what information would be disclosed. So the proposed disclosures about performance of a business combination would follow, as we said, management approach. So management approach dictates what information an entity would disclose and for how long. There are some examples of disclosures in the appendix. So for example, a target could be an increasing market share in North America to 20% by 2030. And the disclosure for subsequent performance then include the actual performance. So for example, market share of 16% and a statement on whether performance is meeting the target. And the ISB decision was to require an entity disclose what its key management personnel is reviewing. And key management personnel is a term that is already defined in IS 24. And so we believe that stakeholders should be familiar with that. And if we're moving on to the right-hand side, so when it comes to applying the proposals, an entity would be required to disclose information about the performance of a business combination for as long as key management personnel reviews this information. And what that means in this context is just comparing actual performance to the acquisition date, key objectives, and related targets. And I would like to stress that we're talking about the acquisition date, key objectives and targets, and not objectives or targets that management may set in the future, because we feel this provides a closer link to the acquisition price for the business combination, and thereby helping investors to hold management accountable for their decisions on capital allocations. And we do understand that in some cases, so there are additional requirements if key management personnel stop reviewing performance against the targets before the end of the second year after the year of the acquisition. So moving on to the next slide. So this slide explains more about thresholds and what we envisioned there. So an entity would not need to provide information about performance for all its business combinations, as I said, but only a subset of what we labeled as strategic business combinations. And the purpose of this proposal is to reduce the number of business combinations and capturing only the most important ones to the investors, and also reducing the costs of applying the proposals. And so the ISB is proposing quantitative and qualitative thresholds, and meeting any of these thresholds will make the business combination strategic. So the requirements I just explained would apply. So the quantitative thresholds are based on the thresholds used by regulators to identify business combinations. So there are already some in different regulatory regimes. We have these different quantitative thresholds, and what we heard is that, I mean, there's some what we heard, this 10% is right, but yeah. So the ISB is using a mix of different line items, such as revenue, operating profit, or assets, including goodwill, to cater for different reasons for entering into a business combination. And the ISB, as I said, proposes the thresholds at 10%. And although we do, to some extent, accept that this is arbitrary, this is, as I said, percentage which is used within the range by regulators. And it's also a figure used in IFRS 8. And so, and then in terms of qualitative thresholds, their intent is to capture business combinations that might be important for an entity, but are not large in size. And so these thresholds are based on IFRS 5 requirements. And so if we move on to the next slide. So now we're going to talk about the proposed disclosure requirements relating to expected synergies. So IFRS 3 already requires entities to disclose qualitative information about the factors that make up goodwill, which lists information about synergies as an example of such a factor. The proposal therefore builds on an existing requirement and just requires quantitative information on top of that. The proposals would require an entity to specify the different categories of expected synergies from the business combination, like, for example, revenue synergies, cost synergies, tax synergies. And for each of these categories, we would require an entity to disclose the amount of expected synergies, the expected costs to achieve those, and the time frame over which the benefits from synergies are expected to accrue. The quantitative figures for synergies could be disclosed as a point estimate or as a range. And the disclosure of expected synergies is only required in the year of acquisition. So companies typically wouldn't need to disclose whether synergies are actually achieved in the future. And companies would only disclose achievement of synergies if achieving the expected synergy is a key objective for a strategic business combination. So the acquisition date disclosures of expected synergies will be required for all material business combination, which is the same population as the existing disclosure requirements in IFRS 3. And now let's move on to the next slide, where I'll talk a bit about the exemption. So the design of exemption is aimed at responding to preparers' concerns about potential commercial sensitivity, and also respond to concerns relating concerns about forward-looking information and litigation risks which may arise because of this information being disclosed. And there is a principle for this exemption, which is an entity can be exempt from disclosing information if disclosing it can be expected to seriously prejudice the achievement of a key objective for the business combination. And so entities will be required to disclose the reason for applying the exemption for each item of information it is used for. And this is based on the wording of a similar exemption in IS 37. Although unlike IS 37, we haven't used the phrase in extremely rare circumstances. And instead, we propose application guidance on when the exemption can and cannot be applied. So this application guidance builds on the requirement the ISB has observed in similar exemptions that exist in various regulatory regimes. And so what we've been trying to hear from our stakeholders is whether the exemption can be applied in the circumstances preparers needed, and also whether auditors and regulators think there are sufficient requirements to restrict the use of the exemption, but only in the circumstances the ISB intended to use it for. So if we move on to the next slide. So this slide basically just summarizes what we've been discussing so far, and also it shows when the exemption would apply to. And here I'll only focus on the ones which the exemption wouldn't apply to. So if we start from the top left, so one part that I haven't mentioned yet is a proposal to replace the requirements to disclose the primary reason for a business combination with the requirement to disclose the strategic rationale for the business combination. And we believe this links the entity's overall strategy with the objectives for the business combination. And what we heard is this is not usually commercially sensitive, and investors also say they need it, so the exemption couldn't be applied. Now, if we move on to the bottom left, and I've already explained that the key objectives and targets in the year of acquisition and proposals relating to that. So feedback suggests this could be commercially sensitive, and so the exemption could apply. And if we look on the right-hand side, there's no requirements to disclose the performance for synergies in periods after the business combination. So then if you look at the bottom right, so what we hear from respondents is that they say that the actual performance in subsequent periods is not information that is commercially sensitive, However, we've heard some concerns that if a target was commercially sensitive, then stating whether the performance is meeting the target could also be sensitive. So therefore, in subsequent periods, information about actual performance would not qualify for the exemption, but the statement on whether performance met the target would qualify for the exemption. And then moving on to the next slide. So these next few slides are mostly about frequently asked questions. So I will go through some of those. And so some respondents questioned whether information about the performance of a business combination and expected synergies should be included in the financial statements, or, for example, whether they should be included in management commentary. And what we heard from some respondents is that the information is not related to entities, assets, and liabilities. However, the ISB disagrees. And so in the ISB's view, this information explains the price the entity paid for the business combination, and that price is reflected in the value of the assets and liabilities recognized on acquisition, particularly goodwill. And for example, IFRS 3 already requires an entity to disclose qualitative information about expected synergies, as I mentioned previously, which highlights the link between synergy information and goodwill. And also what we hear from some other respondents is that information is forward-looking, and so it doesn't belong in a financial statement. However, some ISB members consider this information, so information about objectives, targets, and synergies, not to be forward-looking. And this is because this information is captured in the assumptions that underpin the price paid for the business combination. So the business combination reported in the financial statements is a past transaction and therefore not a future transaction. And also, the ISB considered the position, even if the information is forward-looking, and the ISB looked at the conceptual framework, which sets conditions for whether to include this type of information in financial statements. And there's certain conditions, and these conditions are that the information has to be related to entities, assets, liabilities, income, or expenses, and that the information is useful to investors. So the ISB notes that the information meets both of these conditions. And so therefore, the ISB concluded that information about performance of a business combination and synergies can be required in financial statements. So if we move on to the next slide. So yeah, we've heard from some respondents. So on integration, we've heard that acquired businesses are quickly integrated into an existing business, and that an entity's management does not track the business separately. So, however, the proposals would not require an entity to track the performance of acquired business in isolation. And because the management approach is flexible and focuses on the outcome of the combination rather than the acquired business specifically, an entity would be required only to disclose what information its key management personnel is using to assess the performance of a business combination. And then we heard also some concerns on auditability, and some stakeholders question whether the information is auditable, and particularly information about targets measured using a non-currency measurement unit. And so the ISB has consulted with auditors on this question, and most auditors said this information will be auditable, however, at an extra cost. And the ISB considered this cost in assessing the benefits of the proposals, outweighing the cost. And also, the ISB is not expecting an auditor to give their opinion on whether the objectives and targets for business combinations are appropriate. So the expectation here is that an auditor will be able to confirm that the actual information disclosed is the information reviewed by the entity's key management personnel, and that the entity has adequately explained how that information was prepared. So if we move on to the next slide. So yes, so far we've focused on the two bigger disclosure changes. So about the performance of a business combination and synergies. However, there are a few smaller amendments that I'll quickly explain on the next two slides. So on disclosure objectives, the ISB is proposing to add a new disclose objective to IFRS 3. And this objective has been designed to meet the information needs of investors for information investors said they need but do not currently receive. And then on strategic rationale, there's been a replacement for the existing requirement to disclose the primary reason for the business combination. And the idea here is to require an entity to provide information that links entities' overall business strategy with the objectives for the business combination. And then if we move on to the next slide, the last one, I believe, from this section. So on combined entity information, so IFRS 3 already requires an entity to disclose information about the contributions of a business combination, including what is sometimes called pro forma information. And so the ISB decided to retain this requirement. And although some preparers said it's costly to prepare, investors highlighted this information as the one that has high value to them. And the ISB is proposing to specify that the profit figure disclosed is operating profit or loss. We believe this reduces diversity in terms of what type of profit entities disclose. And operating profit also means that entities will not need to make estimations of the effect on financing income and expenses, which has been one source of cost some entities incurred when applying the requirements today. And also stakeholders said the ISB should provide guidance on how to calculate combined entity information. For example, what to do with transactions between the entity and the acquired business before the acquisition date. And so the ISB decided it is not possible to provide application guidance for all situations entities might have questions about. However, the ISB is proposing to explain what this requirement is for, which will give a general framework for an entity to make a judgment on how to calculate this. And the ISB is also specifying that this is an accounting policy. And so to the extent the information is material, an entity would be required to disclose the basis of preparation. And finally, on defined benefits, pensions, and financing liabilities. So we've heard from some investors that they consider these liabilities to be a part of the capital employed in the business combination, but that some entities do not disclose this information in their financial statements. So IFRS 3 already requires information about assets acquired and liabilities assumed, and therefore taking a principle-based approach, the ISB has not specifically requested separate disclosure of pensions and financing liabilities. And instead, the ISB is proposing to add these to the illustrative examples in IFRS 3 to highlight more clearly the need for this information. And so with that, I'd like to hand over to Akshaya.
Thank you, Ms. Love. Good evening, everyone. So moving on to the next slide. In the PIR of IFRS 3, the IASB heard a number of concerns about the accounting for goodwill. Stakeholders said there appears to be a delay between an impairment event occurring and an impairment loss on goodwill being recognized. This is sometimes referred to as impairment losses being recognized too late. Some preparers said the impairment test is too costly and complex to apply, and some stakeholders said the IASB should reintroduce amortization of goodwill. Now, the IASB considered all three of these areas and is proposing amendments to address the first two, but decided there was no compelling evidence to reintroduce amortization of goodwill. So moving on to slide 25. The IASB considered why stakeholders provided feedback that impairment losses on goodwill are being recognized too late, and noted that the impairment test is a test of a group of assets or a cash generating unit that generate cash flows together. This is because Goodwill does not generate cash flows on its own. So accordingly, the impairment test is not a direct test of Goodwill. It was not designed to show the success of the business combination or to illustrate a steady decline in the value of Goodwill over time. Instead, the new disclosure proposals that we just covered in the last section would help investors assess the success of a business combination more directly. The IASB spent a long time considering completely different impairment tests. So, for example, the IASB spent time investigating a headroom approach. Headroom is the amount by which a business's recoverable amount exceeds the carrying amount of its recognized net assets. So, the headroom approach aimed to build some of this headroom into the impairment test. However, stakeholders did not support the IASB's ideas in this area. So the IASB instead focused on making changes to the existing impairment test. Now, it identified two reasons why impairment losses on Goodwill might be recognized later than some think that they should be. And the two reasons are shielding and management over optimism, which we will cover in the next slides. The IASB is proposing some changes to the impairment test that aim to reduce shielding and management over optimism. So moving on to the next slide. In improving the effectiveness of the impairment test, the IASB has focused on what changes it can make to the impairment test in IAS 36 and is proposing to reduce shielding in the impairment test by proposing to clarify how an entity allocates goodwill to cash-generating units for impairment testing. Previous outreach identified some potential barriers in the wording in IAS 36 that might result in entities allocating goodwill at a higher level than the IASB originally intended. Potentially the goodwill was being allocated to the operating segment when information is available to test goodwill at a lower level. So what that means is entities were defaulting to the operating segment as the CGU. The IASB is now proposing clarifications to the wording in IAS 36 to remove these barriers, hopefully resulting in entities allocating goodwill to cash-generating units in the way the IASB had initially intended, thus reducing shielding in the impairment test. Moving on to slide 27. To reduce management over optimism, the IASB is proposing to require entities to disclose in which reportable segment a cash-generating unit is in. The idea of this information is to enable investors to better link the information about assumptions in the impairment test with segment information. And this, in turn, will help investors to better assess whether the assumptions that are being used in the impairment test are reasonable. Moving on to the next slide. The IASB is also proposing changes to how an entity calculates value in use, which it hopes will reduce both the cost and complexity of the impairment test and also improve the information that's being obtained from it. In particular, the IASB is proposing firstly, to remove the restriction on including cash flows from a future restructuring or asset enhancement. These changes will bring the cash flow forecast used in calculating value in use closer to the cash flows used by management in managing the business. This then reduces the need for entities to make artificial judgments on what cash flows to include or exclude, which is the practice right now. The second proposal is to remove the requirement to use pre-tax discount rates in calculating value in use. Moving on to the next slide. Finally, the IASB considered reintroducing amortization of goodwill and received substantial and conflicting evidence from stakeholders on this topic. Feedback shows that stakeholders have differing views supported by evidence on the appropriate model to account for goodwill. Many IASB members acknowledged the pros and cons of both models. However, based on the evidence received, the IASB concluded that it does not have a compelling case to change from the impairment-only model either to improve information provided to investors or to reduce the costs for companies. So that brings us to the end of the presentation, and we can now hand over to the panel.
Thank you. Thank you very much. Thank you very much. In fact, it was a very nice view which you have given for this exposure draft. So I really thank you. Now we'll be having a discussion on the panel mode. And for that, we have, as a panelist, of course, we'll be having Mr. Zachary Ghast, who's the member of IASB. So bring the person who has who has brought these proposed amendments in the IFRS 3 to have the prospect from the Indian perspective. We have got CA Sanjay Vasudevaji, who has got more than 30 years of experience, and he's a past council member. He has served, continuously serving to the community, chartered accountant community in India and overseas, on the assurance field, and of course the IFRS and the Ind AS field. He has been part of so many committees of ICI, including the Accounting Standard Board, Expert Advisory Committee, and so many. And of course, he is currently the member of the Corporate Laws Committee of the PhD Chamber of Commerce and the CII National Committee on Financial Reporting. Also, we have, and actually, Sanjay Vasudevaji would be bringing out the perspective from the auditor point of view, because he's an avid auditor. So we have our three panelists from India, Dr. Avinash Chandra, who is an academician, CA Sanjay Vasudevaji, who's an auditor, and of course we've got CA Smriti ji, who is a preparer. So we've got a preparer, academician, and an auditor, the whole three area where these standards are to be amended for. So we have Dr. Avinash Chandra again, who is an avid academician, I would say, a distinguished leader in the accounting standard field. We always say in our board that Dr. Avinash Chandra, IFRS is in his blood. I don't know whether he sleeps at that time also. He talks about IFRS and Ind AS or not, but yes, of course, over more than 4 decades, he has got that experience. He has served as the technical director and the secretariat of this Accounting Standard Board of ICI. Also, he is holding the role of director in one of the Section 8 companies of ICI, the XBRL India. He's got an international influence which is profound, which is for representing India for 15 years at the IASB meetings, contributing to all the global practices. He actively participates in the national and international forums, including the Women Finance Officers Association conferences in the USA, and is also a member of the International Taxonomy Consultative Group, ITCG, of the IFRS Foundation. As I said, CA Smriti Goyal, seasoned professional and the group controller of one of the prestigious group in India. The company is Tata Motors Limited from the Tata Group. She has been with the Tata Motors for more than 2 decades, holding various finance positions within the company. Also, she's a rank holder, which is the rank in qualifying CA. So, the academician, the preparer, and the auditor, all three, along with the person who has brought these amendments as an exposure draft from the IASB, so all 4. And so to moderate all these 4, we have got another excellent personality, say Sumit Seth from Mumbai, who has got again more than 26 years of experience and one of the big 4s, and he specialized into the public and the private held companies, including the emerging and multinational corporations. And of course, sustainability is this new area, and is also the special invitee to this board, and he contributes very, very regularly to the ASB and EAC many times. So now, for the panel discussion, I'll request Sumit Seth to take over, please.
Yeah. So thank you very much, Chairman, and thank you the IT staff for such insightful comments. You tried to really simplify, what's written in the exposure draft. So maybe I'll start and I'll start with Dr. Avinash first. As we've heard, I think we were still learning about materiality. At least I've continued to learn about materiality. But Dr. Avinash, we have now, as per the exposure draft, we have something which is, material business combinations, and now there's another subset which is strategic business combination. Of course, they both have, certain set of disclosures. How, in your kind of view, and how you see it, do you think this is, something which will be helpful, from investors' perspective? Will it be understood, by preparers? And maybe if for Sanjay, I will ask later about auditors. But maybe if I can go with you, what's your take on this, Dr. Avinash?
Thank you very much. Yeah, thank you very much. And I am grateful for the opportunity which is given to me to react to some of the proposals which have been made in this exposure draft. And your question is primarily on the appropriateness of whether there should be two sets of disclosures. One set for the material business combinations and the other set for the strategic business combinations. And as the scheme of the exposure draft goes, it is apparent that first the entity will have to identify the material business combinations. And for that, it has been mentioned in BC 53 that IASB's proposals do not attempt to define or explain how an entity makes materiality assessments. So materiality assessments with regard to the items to be disclosed and the material business combinations to be identified, it has been left to the entities, keeping in view the materiality concept, if we may say. But at the same time, the exposure draft prescribes some criteria with regard to which the strategic business combinations are to be identified for the purpose of making disclosures with regard to the targets and to assess the performance. So in other words, as it has already been mentioned, the strategic business combination disclosures are for a subset of the material business combinations. And for that, the criteria have been separately identified. So in that regard, a few questions were arising in my mind. One is that for the strategic, to identify strategic business combinations in paragraph B67C, and it has been mentioned in the presentation also that there have been some criteria, quantitative criteria like, 10% of the operating profit and revenue and the assets, and the qualitative criteria like, the line of business, etc. So one question which was coming to my mind was that whether, while the IASB has said in BC 53, which I just now read out, that the IASB proposals do not attempt to define or explain how the material assessments have to be made. But the criteria have been laid down like 10% and the qualitative criteria like the line of business, etc. So one may raise an issue as to whether whether we are limiting the criteria for assessing the material business combinations. Because if the 10% of, say, revenue or say operating profit, etc., is for the subset as such, which is supposed to be at a higher level compared to the material business combinations. So whether the material business combinations have to be, the criteria have to be lesser than those which have been prescribed in B67C. But for example, you know, so whether it is so, then in a way, the criteria for assessing material business combinations are being made limited. So they have to be lesser than, say, 10%, or they have to be not necessarily line of business. Whereas actually, it is possible that some of the entities may have the materiality assessments based on similar criteria as has been identified for the strategic business combinations, like, say, as a percentage of operating profit, or even some entity may say that I consider a line of business as a material business combinations. So if that situation arises, then there would not be any difference between the material business combination and the strategic business combination. And it is also possible that for, say, large international conglomerates, that the materiality assessment may be even higher than what has been specified in paragraph B67C. For example, say for international conglomerates, somebody may say, I assess materiality as 15% of operating profit. While I understand, as it has been mentioned in the presentation also, and it has been specified in the basis for conclusions also, that the IASB has, you know, specified these criteria of 10%, keeping in view the regulatory requirements in some jurisdictions. But at the same time, there is a possibility that these criteria may, I mean, how these criteria may interact with the materiality assessment. So that could be one aspect which could be considered. I don't know whether the IASB has assessed that type of application issue. Another issue in this regard, which of course these are the smaller issues, but these may have some practical implications with regard to the disclosures to be made or the labels to be given in the financial statements. For example, let's say one company in a particular year has two business combinations, one belonging to the class of material business combination, and the second one, related to the strategic business combination. So now supposing the company also labels these two business combinations separately as material, for example, the second business combination as strategic business combination, then in the user's mind, the one obvious question may arise as to whether the other business combinations, which are not strategic combinations, or in other words, non-strategic business combinations, they are not strategic. Although, in the other disclosures which have been mentioned, you have for each business combination, for example, in paragraph B64A, for each business combination, which is material, whether it is strategic or not, you have to specify the strategic rationale. So in other words, all business combinations have strategy in mind at the time when a business combination is attempted or made. So therefore, I mean, the question will arise as to for example, the company also labels it as a strategic business combination, as to whether the other business combination are not strategic. Obviously, the strategy is there for all business combinations. So maybe some kind of maybe clarification or maybe some guidance could be included as such. And then, you know, they may also wonder as to whether I mean, if all business combination have a strategic rationale, then why only for a subset you give additional disclosures which you know, provide you the performance information about the performance of the business combination. Why that performance indicators are not provided for the other business combination, which are also strategic in nature. So therefore, there could be some either guidance to be provided as to how to disclose, the manner of disclosure, and whether one could also think of restricting the disclosures, even the performance disclosure, which are relevant to the strategic business combination, to all material business combinations as well. I understand that the IASB is making the subset, keeping in view the costs and benefits consideration. But at the same time, when we say that the other business combinations are material business combination, according to the materiality concept, which influence the decision of the users, which are supposed to influence the decisions of the users. The material business combinations are supposed to influence the decision of the users. Then why not the same disclosures which are there for strategic business combinations should also be there for the material business combination? Of course, I take the point with regard to the cost and benefit. I'm only speaking from the user's perspective as such, although some of the users may be using information even for the I mean, only for the strategic business combinations. So, sorry. So in other words, the point is, I mean, the small point which I am trying to make is that while I understand from where the IASB is coming from in terms of costs and benefits, but at the same time, the manner of disclosure, the labels to be given, and the application of the criteria for selection of materiality and the subset for strategic business combination may have some practical information from the preparer's perspective as well as from the user's perspective. Thank you very much. I had to say this much only for this question.
Sure. Thanks. Thank you, Dr. Avinash. But maybe, Zach, if I can just go over to you, and if you have any maybe reactions to what Dr. Avinash said. I mean, the way I understand is, of course, there are material business combinations. Yes, strategic business combination. That's a term coined in this exposure draft. I think someone alluded earlier whether that's the best word or not. I think that's what Dr. Avinash is also trying to get to, that, you know, from a reader's perspective, if there's a business combination which is material, but then you don't call it strategic, at the same time you have to disclose strategic rationale. So is there some kind of better clarity needed in that? Yeah, maybe over to you if you have any inputs on that.
Yeah, I think where we focused, because companies have identified material business combinations throughout their time as IFRS reporters, we tended to focus more on the identification of what we called the strategic business combinations. In retrospect, after hearing all the feedback, I certainly agree we could have picked a better name for that, since I absolutely agree that all business combinations are strategic in one way or another. So I think we're going to look really hard, or I'm going to work to find a better name for that, just so we single out, these are the key acquisitions. That's the idea we were going for. These are the ones where we thought in balancing the cost of preparing information and the benefits to users, where the enhanced information would be worth the additional cost for the additional disclosures.
Correct. Absolutely. I think that's what I was going to say. Is that where you need additional disclosures, you kind of define. Smriti, you can go first, and then Sanjay can follow. There is an expectation in the exposure draft that for all material business combinations, you also ought to disclose expected synergies, and there are examples around that. Revenues, costs, and others, and also certain additional information around that. Maybe what's your kind of input on this as you read the exposure draft? Is this something clearly understood? Specifically, the terms synergies, and secondly, do you see any challenges from a preparer's perspective? And Sanjay, from your side, as an auditor, do you see any challenges? So maybe Smriti, if you can go first.
Thanks, Sumit. And it's a good question from a preparer perspective, and also thanks Institute for inviting me and sharing my thoughts. So few things. So whenever a company acquires a business, right? Typically, we do call it out at, okay, why we have been acquiring a business, what is the rationale behind it, and generally anything that the company will be acquiring, there is a strategic intention that, okay, why a particular company has been acquired. So from that perspective, I will say qualitatively, there is enough information which is available to say why a business acquisition has happened and why a company has acquired a business. So that's very clear. At the same time, I will say it's a welcome change where it is being proposed that later on, let the business or the company also confirm that, okay, whatever we said that, okay, this is the strategy and this is the intention behind acquiring a business, whether we are able to fulfill that or achieve that or not. So yes, it's a good one from an investor perspective to understand that better, that later on, whether the combination was successful or whether the intention of the management at that point in time have been achieved or not. But there are a few nuances when we get in terms of disclosing such information. One is when we start giving quantitative disclosures, the things will come in is it will be obviously something which is like forward looking in terms of, okay, what as of now management is thinking and it's their own best estimate, what is the kind of synergy that we will be able to achieve in. There will be certain risks involved with that. What I will suggest that when such informations are being given, we do also caveat it with certain kind of sensitivity around it. Sensitivity not in the sense of sensitive information, but maybe some kind of a sensitivity analysis that if a particular estimate of the management, say, go plus minus 10% or 20%, what that can be or what impact it could have on, say, cost, revenue, or other things. Also, at the same time, there can be some synergies which we are talking about cannot be quantified. Say, for example, a company acquires another company which is very good in digital marketing or something like that. And they take in this company to say that, okay, I will be able to expand my customer base and my customer experience through digital. Now, how do we quantify that synergy which is going to come in through better customer experience? So those are certain things, nuances which may come in while quantifying the data. So maybe we have to also get into that there can be some qualitative synergies which may come in and which will be very hard to quantify. So how do we deal with those? Some kind of examples can be given while we finally finalize the standard. That will be helpful. And third will be when we start looking into, okay, this is the target that we took when we took the business combination, the service, what is the actual, it can be combination of an organic growth of that business as well as the synergies that is being built by the business combination. Then how do you split that while giving the disclosure can be a challenge. And given all these, I'm not sure that how much auditors will put their pen on that to say that, okay, these are the estimates management has done in, this is the way they have disclosed it. and how then they say that, okay, whatever has been given is true and fair.
Right.
Over to you, Sanjay.
Thanks, Smriti. Sanjay, from your perspective, I think Smriti ended it with the auditor's, statement and right in for you.
No, thank you very much. And again, thanks to ASB and ISB for this opportunity. So I have, 3-4 points, and these are personal, and I'd be happy to hear a different perspective. Am I audible in this?
Yes, yes.
So quickly, the first, is that, and I'll just turn it around. I wanted to speak on the forward-looking, but first I'll talk about the auditors. So from an ISB perspective, what is required from an auditability, and in the BC 145, they've talked about, the ISB expects auditors and regulators to be able to verify whether information disclosed is the information that key management personnel receive to review, and then whether there are adequate explanations and appropriate evidence supporting the information, and then whether information faithfully represents what is proposed to represent. So which means that anything which is going to come there, and the auditor is going to obviously sign off. So there is an expectation that whatever has come there, the auditor has come with the blessings of the auditor. So that is the overriding thing. So then we go on. So which means that, is it forward-looking? Is it something which you're standing by, and you are, as Smriti also said, is the auditor agreeing to this? Now, in the past, we have not been agreeing on management projections. Now, for that, I just take you to the other aspect, which is, and the ISB has discussed it extensively, on forward-looking information. And so there have been, in the basis of conclusion also, it has been mentioned that some views have been expressed as whether this is forward-looking or not. And the aspect has been that if it relates to assets and liabilities which are there in the balance sheet, then it is not forward-looking. However, I just wanted to understand that, because even as and so, just going back, it says that at the time the acquisition was made or the decision was made, this was built into the purchase price. But even at the balance sheet date, all this information is going to be forward-looking, because it is going to happen. The synergy is going to happen or not going to happen is still forward-looking. Having said that, and then the basis of conclusion also mentions that in some jurisdiction, there could be an issue with regard to what is forward-looking and how the auditors can opine on that. Now, my concern, and the institute representatives are here, is that the code of conduct bars the chartered accountants from certifying anything which is forward-looking, contingent earnings and all. And that is the reason why SE 3400 was also changed here to make it not the highest level of assurance, but a very moderate level of assurance. Now, if this is said to be forward-looking, and I think this needs further examination, and I'd be happy to be challenged that it is not, then there could be a serious issue in terms of providing assurance, because if it is coming in the financial statements, to that effect, then auditors have provided assurance. So that was the first part. Then the aspect, if we move on and we get past that, then the other aspect with regard to, again, the auditor, having to opine on this, that I've already mentioned. The other aspect is that, this differentiation between, as Avinash Chandraji also mentioned, between material, strategic, that discussion in terms of what the management feels is strategic or not, what the auditor feels is strategic or material, I think that could be another challenge. The other aspect, which coming to the exemptions. So there are exemptions given where, again, I feel, that the management wanting to avail those exemptions on some basis, and because it does not provide an exhaustive list, obviously it's something which is, the management has to see. But again, that to my mind could be, a challenge, and could create some kind of a dissonance between the auditor and the preparer. So I know it has been discussed, and the presentation made that clear, that in terms of where this information really needs to be, My sense still would be that if it can form part of the management commentary or the management, the M&DA, I think that could serve the purpose, rather than the auditor also having to, because as Smriti mentioned, this is information which is available with the management on strategy, strategic rationale and all, everything is there, and it forms part of the management discussion and the management decision. I think it is something which rests with the management. So I think I'll just, so those were my brief points which I wanted to make. Hopefully I've, Sumit, been able to express the concern of the auditors, and I see you smiling, so maybe I've touched a chord, a chord with you also.
Yeah. No, actually, no, thank you very much. That was very well articulated, Sanjay. And I think in my own words, if I can say, and also what I've read in some of the common letters, the point about expectation gap, and obviously there is already, an expectation gap for a variety of reasons. I think this is one area, points around one, of course, forward looking, like you said. I think Smriti articulated that sometimes the synergies may not be quantified. It may be more qualitative. So I think that all kind of obviously adds to this. And so thank you for that, both of you. But maybe if I can just move back to Dr. Avinash and also Zach, I think some of the points and also one point which Sanjay was making about, the acquisitions, the criteria which have been used. And again, it has qualitative criteria more aligned to IFRS 5, but also it has the 10% threshold, in terms of revenue, profits, assets, and then so forth. So, any thoughts, as to is that, are those criteria, reasonable? Is there a need for maybe to look at that a little differently? Because again, for large organizations, a 10% could be a lower threshold. For smaller organizations who are growing, who may be more acquisitive, the 10% criteria could get, met more easily, and therefore, is there maybe a need to also look at a higher or a different percentage or criteria? So, Dr. Avinash, first to you, and then maybe to Zach for his reactions.
Yeah, thank you. Yeah, actually, the exposure draft lists the criteria which are, as I mentioned earlier, and the quantitative thresholds and the qualitative thresholds. And the exposure draft has selected what it calls as a closed list rather than an open list. So the open list criteria is what the IFRS has in IAS 21 in the identification of the functional currency. And the closed list is there for IFRS 8 when you identify the operating segments. But one distinction I'll just mention, because it has been referred to in the BC also, that in IFRS 8 gives a closed list, and the current exposure draft has followed that approach. But as I understand, in IFRS 8, you don't first have to identify what are material operating segments. So you follow the management approach for the identification of the operating segments, and then there are, the quantitative thresholds being laid down for the operating segments, say 10% of revenue, etc. So, but in other words, in IFRS 8, you don't first identify what are material operating segments, and then you go into the quantitative thresholds to identify the subset of operating segments. There is nothing like that in IFRS 8. Whereas here, the proposal is that you have two sets of disclosures or two sets of these business combinations for the purpose of making the disclosures. And it has also been mentioned in the BC that the IASB has not elected to apply the open list approach like IAS 21 because they felt that if they followed the open list approach, it would have sounded like, that they are giving some guidance with regard to the materiality or material business combination rather than for strategic business combinations. And therefore, they have gone for this approach, which is called as a closed list approach. So as I mentioned in my earlier comment also, that while there can be an issue with regard to, an interaction with materiality in the open list approach, as it has been mentioned in BC 60A. There can be a similar concern if you follow the closed list approach also, that, in the closed list, as I mentioned earlier, an entity may follow, even in the closed list approach, the criteria which may result into, let's say, the materiality considerations being higher than what has been specified in B67C as such. So therefore one will have to look into as to what can be the best approach to be followed. While the closed list approach has the advantage of being objective and auditable and all that. At the same time, the issue which Sumit mentioned, that the 10% may be too low, and in some jurisdictions, I understand that even for regulatory purposes, the percentages are more than 20% and going up to 30%. It has been mentioned in the BC also. So probably, I think if you want to retain the closed list, there could be a case for increasing the threshold, and it is also, if it is also possible, I'm just giving a view that whether these criteria can be somehow linked with the materiality considerations. That is something additional to what you have selected for the material business combination. Can there be some guidance as to what can be in addition to the additional criteria for your material business combination selection? So what should be the addition at the moment? I'm not able to say it, but one can have, if it is accepted in concept or as an approach, then one can look into in detail as to how it can be linked to the materiality threshold which an entity applies. For example, if an entity applies a 10% materiality threshold for selecting the material business combinations, so maybe one can say that 5% more or 10% more than what you have already applied, if you have followed the quantitative thresholds as such. So that was just with regard to the thresholds which have been specified. And just one small comment with regard to, an issue which may arise, because paragraph B67 says that these percentages are to be applied based on the most recent material reporting period before the acquisition date. Now, what can happen is that the acquiree is following a gap which is different from IFRS. And it happens very frequently. For example, in India, we have two gaps, and there are smaller companies which follow different gaps compared to the companies which follow the Ind AS or which are corresponding to IFRS. So if the acquiree is following a different gap, and then the operating profit, etc., has to be assessed based on the most recent annual report, then it may not be available. So then the question arises as to how you apply these, these criteria as to what should be done. Do you ask the acquiree to first prepare the profit or to determine the operating profit as per IFRS 18 based on IFRS 18, that is following the principles of IFRS instead of the local gaps, and that would be a little too cumbersome, and therefore it may be useful if some criteria can be worked out based on the percentages for the local gaps themselves. I mean, as such, otherwise, this exercise may become a little costly. So these are the couple of points which I had to mention insofar as the threshold specified for the purpose of identification of the strategic business combinations are concerned. Thank you.
Right. Thank you. Just moving on, maybe I'll again go back to Smriti, and then Sanjay, please, even you can come in on this. I think we spoke about the synergies, but also there is a fair bit of disclosures that are required in terms of key objectives, which was kind of identified at the time of acquisition, a specific statement that the objectives continue to be met or not. And I think the third, which was important, is the targets which were set, and then obviously putting out the kind of how those targets are being met. So do you think, is there a lot of overload of information out there, and does it serve the intended objectives of this project, which was providing relevant and useful information to evaluate the success of a business combination? So maybe Sanjay, if you want to go first, and then Smriti, you can come in.
Yeah, sure, Sumit. Thank you. So my concern, which I mentioned for the overall business combination disclosure, still remains in terms of forward looking. So if you're looking at strategic, the requirement for targets and whatever information is being reviewed and how it is being monitored. So there are two things here. One is the threshold. I think a lot has been spoken about on the threshold, 10%, the quantitative. So I won't go into that, but just wanted to understand that this is a criteria is it also for determining impairment tomorrow or not? In that respect, whether the threshold should be of on equity and whether but the bigger concern from an audit perspective is that this disclosure is made and the target is not met. Now, does that mean that an impairment is triggered? And if it is not met, to what extent can the auditor also be questioned to that extent that okay, this is something which was agreed with the management to disclose, and the auditor obviously agreed on it based on the evidence. And tomorrow, if that is not so, that I think is one concern, which the overriding concern I think which I had on this aspect with regard to disclosure of targets on. The other aspect is that yes, it could be an overload in terms of the situations where there are a large number of business combinations. But if it is determined that the disclosure has to be done and it is auditable, once we get through all this, maybe there'll be some changes or there'll be some more guidance or whatever we converge to. I think it will have to be done. Yes, it will result in an additional effort and additional cost. But to that extent, as long as we are able to mitigate the risks which the auditors are going to face in opining on financial statements which have this information there, and tomorrow not being questioned for any divergences, I think it is doable. Obviously, it is doable then with obviously an additional cost and additional time, because a lot of this information is not going to be flowing from the financial. So these are papers which will be in minutes. There will be some recorded. There will be some discussion papers. So getting all that will require time. It has to be available in a certain manner. Again, I'm not questioning the rationale for the objective with business stand, but I'm only saying the process also needs to be looked into. So that information, to summarize, I think if it is required, it can be done. It will definitely be additional disclosure, additional work. But my concern about the risk to the auditors in this forward-looking information and tomorrow not being subject again, as you mentioned, Sumit, and that is what I want, the expectation gap. Are we going to be widening that? Is something which needs to be addressed. So thank you.
Thanks. And Smriti, if you'd like to add, from a preparer's perspective on these, targets, right? How do you feel about that in terms of, disclosing it and then getting it audited?
So one about disclosing it and getting it audited, I think Sanjay has spoken about the audit challenges which is there. But even if we just look in from the reader's perspective, first we give a target and then we say that whether the target has been achieved or not achieved. If it has been achieved, everybody more than happy. But if it is not achieved, again, from a reader perspective, what we all are trying to give them, then obviously there will be a commentary around that why this has not been achieved, why it is triggering or not triggering an impairment analysis for that particular CGU where this business combination has happened. So all these will happen. According to me, it will become too much of overload of information from a reader perspective as well. One is about preparing. Obviously, from a preparation perspective, we can give this was the target, this is the outcome which has happened, XYZ reasons around it. But then from a reader perspective, what they are going to get from that, not very clear on that. And obviously in the financial statements, we do give a lot of informations around goodwill impairment, which is to be tested every year as of now. So we do give in that why goodwill is there in the books or not there in the books. We do give around indefinite life, intangible assets, etc. also. And then this will be one more set of information that will be giving in terms of the business performance target versus actuals.
Thanks. All right. Thanks, Smriti. So maybe Zach, I'll come to you and I'll just take two questions together. One is in the context of, exemptions, and exemptions always closely read. One is, we look at the exposure draft, it has certain situations where the exemption does not apply. So for example, where information is already available, if information, may be negatively viewed by, capital markets and so forth. Do you see any merit in providing some guidance in the context or examples where actually the exemption can be used? So in the sense where it may really cause serious, harm and prejudice in achieving those objectives. So more positive examples of situations. Any thoughts from you on that? Is ISB considering that?
So I think what we would be looking for is situations where it would be useful to have that guidance, keeping in mind that the danger in principles-based standard setting is the more application guidance you give, the more you're moving just towards a rules-based system where you're expected to sort of give guidance on every potential scenario, which is a road we really don't want to go down. There's a room for judgment and there's a room for management to make the decisions they need to make, in partnership with their auditors, who are there to review those judgments. But I think if there are specific scenarios or specific circumstances that would really help define that, we're open to it, but we'd love to hear that back from participants.
Yeah. Okay. All right. Thank you, Zach. And maybe a related point, and as you heard, our other speakers, this whole concept of disclosure, in the financial statements versus management commentary. And I know the ED does, have language around that and a discussion around that. But, is that something, which is up for consideration, especially when, as we heard Smriti, she spoke about qualitative synergies, and also the ED refers to non-financial KPIs, which could be targets or I think synergies. And how does that kind of fit into a financial reporting framework and financial statements when really the notes should try and reflect, information on assets, liabilities, and so forth?
So I think I'll maybe address the forward-looking first. And I think we definitely do have an expectations gap between sort of what the view is that auditors are auditing in terms of reasonableness of assumptions versus whether something is a historical record of the assumptions that were in place at the time you generated a purchase price, which solidifies the tangible and intangible assets and liabilities plus the goodwill that sit on the balance sheet. I think that was the view of the board. That's what you were doing, is you were recognizing what the estimates were that were in place. There's a whole ecosystem in mergers and acquisitions of reasonableness and reasonableness opinions that exists for certainly any of the transactions I would assume go into this strategic or key acquisition bucket that provide that assurance, for better or for worse. I think some people can be critical of those reasonableness opinions, but they exist and they're out there. I wouldn't want auditors to duplicate that work after the fact, because I don't think it serves much purpose. That being said, even if we were to make the decision as a board, which is not where we've arrived in the past, that this would be forward-looking information, I think the conceptual framework specifically calls out scenarios where forward-looking information can be included in the financial statements. And that's where it provides information about the assets and liabilities that sit on the balance sheet. And certainly the purchase price is reflected in assets and liabilities that sit up and down. And goodwill is the residual of those. So it would seem to fall within that bucket as well. The second part of when it can be used is when it's useful to users. And we talked about the genesis of the project being information that users felt they needed to assess the performance of acquisitions. So for me, it definitely hit both of those criteria. I think the non-financial KPIs is an interesting discussion. Much like in IFRS 18, we decided to allow for a management view, which recognizes that when management goes out and does an acquisition, they're not always thinking in terms of revenue and specific costs and the synergies associated with each of those. They could be talking about a specific technology that they really want to integrate into their business. And that doesn't lend itself well to quantifiable synergies. The users we spoke to, they understand that, and they're fine with that. They actually like that some acquisitions aren't going to be about a specific revenue target, or that you don't know what that's going to be going in, but you assess the value of the technology to be X, and you're willing to pay X for that. They're a group that operates well under uncertainty. We always remind people that investors are geniuses if they're perhaps more comfortable with uncertainty than some in the accounting and audit profession are. We do recognize some of the challenges that go with each of those, but just on balance, thought it was worth giving management's view of why they're doing the acquisition, what those indicators would look like, much in the same way that we did with IFRS 18. We have had a suggestion that we consider something like a basis of presentation that says, essentially what we said in IFRS 18. This represents management's view of the key objectives and targets, and it may not be reconcilable to the IFRS numbers.
Okay. All right. Thank you, Zach. And I think just on a lighter note on forward-looking, I think that goodwill itself is forward-looking because the good will come at some point in time. But anyway, that was just to move forward. So maybe I'll change tracks and go to the other topic, which is impairment. And I think we've got some time left. One of the key objectives was to deal with this impairment being too late. Impairment being a proxy to evaluate success of a business combination. And I think the suggestions which are there in the ED, one of course is identifying it at the lowest level, and where the business associated with goodwill is managed. And the second one, of course, is the capping of operating segment level. So maybe, with that background, Smriti, do you see this, first of all, do you see this significantly changing your current practice in the way, Goodwill is dealt with for financial reporting? And second, more important question, does it really deal with this concern of shielding or, recognizing impairment losses later than they should be? Your thoughts, Smriti?
So, if you just looking into from an Ind AS 36 perspective, a cash generating unit is the smallest identifiable group of assets which are able to generate cash flows independently. And typically, from a goodwill perspective, we do then try to say that, okay, for which CGU or the cash generating unit this goodwill pertains to. And accordingly, an impairment testing is being done year on year to say that whether the goodwill has to be impaired or not. Because whenever a particular CGU gives an answer that it has to be impaired, the first thing that a company does is impair the goodwill which they have acquired through a business combination. So from that perspective, I don't think so that there will be any shielding, because year on year you have been doing a testing, impairment testing is there and which is being done. Also, in terms of, I don't think so there will be much of a judgment required in terms of which CGU it pertains to, because typically when you are acquiring a business, you know that you are doing it for which particular cash generating unit or which particular business. There can be times that where in terms of the value from that business that we are acquiring in a new business, or I will say the synergies from that new business can be to various CGUs in a particular existing business. That can be a possibility. But then there are two choices. One is either you allocate it to the highest revenue generator or a cost for which you have acquired that business combination. Or what you can do is you can split that goodwill on day one when the acquisition accounting has happened to say that, okay, X percentage or X number, depending on the formula that the company has been using it, to say that it pertains to this CGU for so much amount and to this CGU for so much amount. So that also can be done. And I particularly, on a personal level, doesn't see a challenge in terms of doing such allocations, provided we disclose that properly if an allocation is happening, that why we are doing between various CGUs. Otherwise, generally what I have seen is straightforward. If a new business has been taken and there is a goodwill which is coming in, we will be able to link it to a particular CGU.
Okay. All right. Thanks, Smriti. There was, maybe Parminder, are there any questions from the audience? If yes, take those. Otherwise, I'll move forward with what I have.
Yeah, there is only one question as of now.
Okay.
I have shared it on group as well.
Maybe you can just read it out.
Yeah, actually, it is saying that impairment testing is carried out at CUG level, which generally is at higher level than acquisition. There appears to be a mismatch, as disclosure would be at acquired entity level while impairment testing would be at CGU level. Even if the acquisition has not achieved its business objectives, goodwill impairment may not be required. So maybe the question is asking about the mismatch at what level the impairment testing of CGU is done and the disclosures asked for.
Right. I know, Zach, do you want to maybe respond to that?
Yeah, so that mismatch we discussed and found was going to be likely, rather than, sporadic. And the next decision was, can we change the impairment test in such a way that it does adequately measure the performance of an acquisition? And the answer we came to was no. We couldn't figure out a good way to do that, simply because of that mismatch between the acquired entity potentially going into multiple CGUs, as Smriti mentioned, or simply being part of a much larger CGU where it was subsumed. And that's where the disclosures essentially came from. So to get back to an earlier question that we had, we don't necessarily think that underperformance of the goals and targets that were identified in the acquisition would lead to an impairment, simply because the impairment test is testing something else. It's testing the cash generating unit that the acquisition is within.
Thank you, Zach. Zach, coming back to you again, actually, this was a question, as even I was reading the ED, as we know, the VIU definition, the restructuring, which is not yet committed, enhancements, improvements to the existing assets, some things like those which were considered in the fair value less cost to sell kind of calculation. Now they've been removed in the context of VIU. So it appears that VIU and fair value less cost to sell will be more aligned. Any thoughts from your perspective as to then what would be the really remaining differences, if any, between the two approaches? And how do you kind of see this, and what was the thinking of ISB around this?
So I would absolutely agree that I think the two are getting closer with these changes. I think value in use is still relevant and worth including because it essentially reflects the value management expects to generate. If you have a unit that sits alongside a separate CGU, but together those two CGUs can generate additional cash, that could be reflected in that. I think it also reflects sort of management optimism, which I don't view as a bad thing. I think over optimism is probably considered a negative, but the people who run businesses own an asset because they think they can generate the same or more value than the market out of that asset. Otherwise, the correct response is to sell it. If your value in use as a management view is lower than the fair value, the appropriate response is to sell it. So what you're essentially getting is management's view that we think we can do better here, which is what you want. That's what they're hired to do. So I don't necessarily view that as a negative. I actually view it as a positive and a reflection of what they're supposed to be doing.
Okay, thank you. Sanjay, over to you. The ED talks about that. Since Zach spoke about management over optimism, it also says that it's best dealt with by auditors and regulators or enforced by them. Any thoughts from your side, on this statement, and whether the standard kind of does enough to deal with that?
So I think, thank you, Sumit. I think there are two parts to the impairment testing, and the one aspect was on shielding. And I think this is something in terms of, I think Smriti also talked about, to what extent, this, at what level at the CGU are you going to do the, testing, impairment testing? And then the question also asking you, are you going to go further lower or not? So I think to some extent, that shielding aspect has been taken care of. We'll have to practically see how that's going to, come. But the management over optimism, there's a discussion in terms, if you look at the basis of conclusion to, 207, and there, there are some thoughts in terms of whether that can be brought in terms of, the projections or, looking at some kind of a budget. But I think they've concluded that that is left to the auditor. So my view is that obviously it is a challenge. You cannot expect only the auditors or the regulators to look at management, optimism. And I think there was some discussion somewhere that there could.
I think maybe we lost Sanjay. Maybe I'll just move forward until he comes back. I think we've probably over the time. Last question to Dr. Avinash. Do you believe that the overall objective of the standard, right, which was to address recognition of impairment losses too late, is that met the current proposal or the kind of package of proposals?
Yeah, I'll be brief in the interest of time. So with regard to the changes which have been carried out in the, which are proposed to be carried out in the exposure draft, it has been mentioned that one changes are changes relating to clarifying how an entity allocates goodwill to the CGUs. Now, here the word which the IASB also itself has used is clarifying. So which means that the principle which was existing and which had been mentioned in paragraph 80 of IAS 36 itself was sufficient. And the additional paragraphs which have been included in the exposure draft, paragraph 80A and 80B, and it has been explained in the presentation also. They clarify that first you identify the lowest level to which the goodwill is to be associated. And then, you go to the operating segment as such, and by default, the entity should not select the operating segment as the CGU. Now, as I understand that paragraph 80 itself means the same thing. And if an entity had in spirit applied paragraph 80 earlier, then probably it does not change the allocation of goodwill to the CGUs by simply adding 80A and 80B to my mind. And although I agree that these are very good clarifications, and if there were some, issues or some lack of guidance earlier in identifying or allocating goodwill to the CGUs, then these paragraphs will be helpful. But in principle, I don't think it is a substantive change which has been carried out, and maybe it is just leads to correction of an error, of errors which the entities had earlier done. And the other changes, disclosing the segment, to which in which the goodwill is included, or the CGU to which the goodwill is included. The objective has been to deal with over-optimism, that the users can compare their own assessment or assumptions with the assumptions which the entity has made. This, I am a little skeptical as to whether the users' assumptions, whether they will have some kind of assumptions which they can, they may not be having realistic assumptions which the management may be having. So that objective, to some extent, I a little skeptical. And lastly, with regard to the computation in value in use, where the guidance has been the change has been made to remove the exclusions with regard to reconstruction and the enhancements of assets, etc. That has been, and now it is proposed that you include the cash flows when you make the estimate of the cash flows, you include the restructuring and the enhancements, etc., keeping in view the current potential of the asset. Now, the term current potential of the asset may be subject to different interpretations, and it may, the word potential itself may lead to, some kind of over-optimism, because the potential, there can be, the word potential can be used in a more liberal sense compared to a planned restructuring or planned enhancements, or, committed restructuring as used in IAS 37. So there is a potential that it may, instead of removing the over-optimism, there is a potential for enhancing over-optimism by making this kind of a change. But otherwise, I am in favor of, including these cash flows in estimates. But only thing is that there have to be some safeguards to be built so that there is no further scope for over optimism from the standards perspective. So that's all I had to say about this. Thank you.
Thank you.
And finally, you asked about whether it is too little or too late. So I think since these are clarificatory in nature, and secondly, the last current potential may lead to over optimism. I am a little hesitant to say that it meets the objective for which the project was started. Thank you.
Okay. Thank you. Thank you. Sorry, Sanjay, you're back. Please, can you complete, what you
I was, in fact, Avinashji just mentioned what I was going to add in terms of the fact. So one is the over-optimism has been left to the auditors. Secondly, this aspect about inclusion of future, restructuring and other aspects, I think gives more leverage to the management to, choose. I think there is a discussion that it is going to bring down the cost and also, not have two different set of cash flows, but my sense is that it could lead to more over optimism. So somewhere my only suggestion is that let it not be left only to the auditors and regulators. If it can be built in, if a check needs to be built in, then let it come through the standard or through a guidance. So then that so the auditors can use that. The preparers can also be responsible for that, and the auditors can then opine on that. That was my limited point. Sorry, I got logged out. Yeah. So.
No, thank you. Thank you very much. And over to you, Chairman. I think we've had this very interesting discussion, and thank you for giving me an opportunity to moderate this panel with such esteemed speakers. So thank you very much for that. Over to you.
Thank you. Thank you very much, Sumit-ji. Thank you, Avinash-ji, Sanjay-ji, Smriti-ji, and of course all the ISB team. And in fact, various issues are discussed from the point of view of preparers and the auditors both. And of course, certain concerns. I hope Zach must have noted that. Now, I'll request my Vice Chairman, C. Abid Sajid, to give his concluding remarks.
Thank you, Chairman. Of course, you've covered some part of my concluding remarks, including Sumit. But still, I have the opportunity of thanking all the distinguished guests and the panelists. Thank you so much. It was a very vital discussion, very important. Of course, the proposed changes which is there in the IFRS 3 in terms of the disclosures. Thank you, Zach, Vikash, Ms. Liv, Akshaya for joining and presenting to all the participants, and of course the experts, the panelists, Dr. Avinash Chandar and Sanjay Vasudeva, and of course Priti from the preparer side. Thank you so much, and the moderator Sumit for taking, I think, each and every point discussing, and I'm sure Zach would have got the inputs based on our discussions with the panelists in terms of the challenges both from the preparer as well as from the auditor's perspective, disclosing the information, the forward-looking information, and of course the targets comparing with the actuals, of course in terms of the user's requirement, how it should be done. I'm sure we get more inputs and suggestions would be submitted to you soon. So thank you everyone, and of course the chairman of the ASB, thank you so much, and the office for initiating this outreach program, very important. And all the participants for joining today. Good evening, everyone. Thank you.
Thank you.
Thank you. Thank you.
Thank you, everyone.
Thank you. Thank you so much.
Bye.
Thank you. Thank you.